right, we are recording, we are live. Good evening, everyone. Good morning, good afternoon from wherever you're joining from. So, today's webinar is going to be an eye-opener to many of us here tonight, not just on prop firms, but trading as a whole. But before I continue, let me make sure that I would like to make sure you can hear me. Please, if you can hear me, just raise your hands, please. If you can hear me, confirm by raising your hands. Okay, I can see one hand raised. Okay, 2, 3, 4, 5. All right. Thank you. So let's jump in. Let's continue. So this webinar is going to be, let me put this on a larger screen. So this webinar is going to be an eye-opener to many of us here tonight. And it's not just on prop firms alone, but trading as a whole. This is a very detailed webinar because I put in a lot of time preparing this tonight's webinar, especially compared to other webinars I've been holding. So if you have any question at any point in time, I would recommend you just jot it down somewhere, just put it down somewhere, because I won't be taking questions until the end. I don't want it to be too lengthy because this is a very, very robust webinar. So I'm going to be showing us certain things within our own trading space and realities in the bigger boys, let me put it that way, trading space also. So please just jot down your questions as I'll be taking them at the end of the webinar. But if point in time, probably due to technical issues, you can just quickly send me a DM. I'll be able to see it here. All right. So yes, how a small $10,000 prop firm account can change your life. Now I'm using $10,000 just to cover every areas. Now for someone else, a small account can be a 100K account. For someone else, it could be 200K. You get the point. So I'm using 10K because I think mostly everyone can afford this, right? At least 90 to 80% of us here can afford a 10K account. So that's why I'm using that, because yes, it can change your trading career. As a matter of fact, 10K was my first prop firm account with MFF back then. MFF used to be my first account because I came into the prop firm space 2022. Yes, I came in a little bit late, but probably I was having, not probably actually, I was actually skeptical about the prop firm space because I was wondering how can I pay $80, $70, $50 for an account, and then you're telling me when I make profit, I'm going to withdraw. So all of those issues was the major reason why I came into the prop firm space a little bit late. All right. So, but today we'll be using 10K. How a small 10K prop firm account can change your life. Yes, and I mean it. At the end of this program, you will understand what I mean by this bold statement I just made here, right? So same market, same charts. The difference is structure and discipline. Let's go to the next slide. So this webinar is not just about money. Of course, we are here because of the money, right? But it's not just about the money, because to get to the money, there are certain things that needs to be put in place within ourselves as traders, right? So a 10K prop firm account is not about just the cash. It's about access, discipline, leverage, and trading like a professional. Because to make withdrawals, you have to trade like a professional. I mean, look at this from other aspects or other walks of life, right? If you're a doctor and you approach your job without any form of structure, you are not going to be successful no matter how good you are. All right. So structure is very important, which includes trading out like a professional and discipline, right? So let's just go on. Why most traders fail? The market is actually not the problem. Most traders fail because of emotional trading. I mean, we are familiar with all of these things I have on the screen right now. Emotional trading, no respect for risk management, no structure, recycling small personal capital. I'm always particular about the small personal capital of a thing. Remember, statistically, they said between 90 to 95, if not even more, traders, retail traders don't make money, right? And over the years, through experience, I've been able to come to the conclusion that it's not because those retail traders don't know how to trade. You can't tell me out of the 95% of retail traders that don't make money, the whole 95% don't actually have a good trading strategy. I don't believe that. Through experience, I don't believe that. The major reason why the number is like that is because those 95% of retail traders don't have enough capital to trade in the first place. All right. How can a professional trader will tell you, hey, target 3%, target 5% on average per month, forgetting the fact that that retail trader you are talking to is actually trading $100 account, a $200 account. How do you expect that trader to be comfortable making 5% per month? I won't be comfortable making 5% per month on a $100, $200 account. Let's be honest with ourselves. I won't be comfortable making 5%. I mean, 5% of $100 is just $5. In today's world, what will that do? That would not even create a scratch on your bills. You understand? So, because of that reason, you're trading a small account because that's what you can afford to lose. You want to go all in. If I'm trading $100 account, best believe I'm not going to be targeting 5%. I'll be looking at tripling that account, which will automatically equate to putting on more risk. So the higher the risk, the higher the profit potential. But the downside is the higher the risk, the easier it is for you to just blow that account in a snap. You understand? So that's why if you've been following me for the longest, I always talk about, hey, if you don't have some money saved away that you can just, some inheritance somewhere that you can just invest in your trading and then make big money, just go for prop firm. That $50 account, trying to flip it week in, week out will never work for you. That's just it. I hate to make bold claims. If you know me for some time now, I hate to make bold claims. But when it comes to this, I would tell you for free that trying to recycle that $50 accounts, $100 accounts, $200 accounts, $500 accounts will not take you anywhere. You will end up blowing it, not because you're a bad trader, but because psychologically you want to make what's going to be worth it at the end of the day, at the end of the month, could be at the end of the week. It depends on the individual trader, right? So talent is useless without discipline. So to make big money, you have to be disciplined. If you have the talent without discipline to grow your account systematically, you're going nowhere. All right. All of these things I'm saying, there's a section within this webinar that is an eye opener, and you don't want to miss that. Data driven eye opener. All right. We'll get there soon. So the truth about funded accounts, a funded account forces maturity. You can't trade recklessly. You can't over leverage. You can't gamble. Let's take, for instance, the brokerage account, right? You open a brokerage account. Okay, not you. Say you have an investor that gives you, let's say, $100,000. I'm talking about raw cash now. Invested, maybe that investor deposited it into their own accounts and then give you the login to trade, knowing fully well that whatever profits you make, you get to divide amongst yourself depending on the agreed percentage, right? Even if you don't know how to trade, you will be more scared to blow that account. Why? There's big money involved. You know the potential of what you can make from that account, and you don't want to blow the account, right? So naturally, even if you don't have the strategy yet, you will want to approach that kind of account professionally. But without strategy, of course, you will still end up messing things up. But you get the point. Now, if you know how to trade, you have a profitable strategy, and Now you're trading a funded account. You've gone through the challenges through prop firms. You've gone through the challenge phases, phase 1 and phase 2. Now you are funded. It's going to force you to grow. It's going to force you to be disciplined. Trust me, many people say ill things about prop firms. Of course, there are bad eggs there, but amongst the reputable prop firms out there, the rules across prop firms forces you to be disciplined, right? You can't afford to trade recklessly. If you make a deposit into your brokerage account, you can do whatever you like. You can blow it in one day, like to zero, right? But with prop firms, they are telling you, hey, you cannot lose to the tune of X percentage. You understand? So you are aware that there's a drawdown limit that you don't want to violate, right? So you have that at the back of your mind. So it forces you to, the discipline forces you to be mature in your trading, right? So the rules force you to grow or you fail fast. It's as simple as that. Before I go on to the next slide, let me just confirm that we are still together. All right. Yes, we are. And yeah, my mic is live. So let's go back to full screen. So for those that joined us late, I said today's webinar is quite robust and took me time to like put it together. So for us not to waste too much time, I won't be taking questions in between the webinar. So I'm going to go through all of the webinar. Then at the end, I'll be taking questions. So if at any point in time you have any question, please just put it down somewhere so that you don't forget. All right, let's continue. Let's go to the next slide. Now let's talk about a relatable story that some of us may still be experiencing right now. I used to be this guy, right? We'll just use a random name for the purpose of today's class. I'm using Daniel, right? So that meets Daniel, a trader just like you and just like me back in the day, right? Or some of you on this call right now. So Daniel traded for 3 years, watched YouTube videos, knew almost all the indicators out there in the market, followed Telegram signals, yet every month ended the same way. The painful pattern: small accounts, big expectations. Does that sound familiar? Small accounts, big expectations. I remember back then when I started out, whenever I study some ebooks, watch some videos on YouTube, there were no much materials like today back then. But I'll feel like, yes, I'm there. I'll trade it a little bit on demo. Then I'll go meet my friends because I didn't have enough money to invest back then. I'll go meet my friends. They give me $100. I think I know how to double this account within a week. That was my mindset then, right? Small accounts, $100 accounts, $200 account, $500 accounts, small accounts, but big expectations. You put all your village problem on that innocent account, right? So one emotional trade, account blown. You repeat, you reset, you regret. Or should I have flipped this the opposite? Regret, reset, repeat. That sounds familiar. Like I said in the beginning, statistically, 90 to 95% or even more percent of retail traders fail. Not because, like I said, through experience, it's not because all of those 95% traders don't have a profitable strategy. It's simply because you won't blame them. They are trading on a small account. Naturally, you would want to make enough that can pay for your, let's not even talk about lavish lifestyle, your immediate bill or bills rather. It's normal, it's human nature. So in a bid to chasing those bigger returns, you end up blowing the account. And that is why I always wonder why people blow their account. Like I've always said, we have two types of traders: the profitable trader the consistently profitable trader and the other trader that is yet to find consistency in their trade, right? The trader that is yet to start making profits will come to you and say, hey, I had a bad month last month in the market. All right, so what was the outcome? I blew my account. Then you meet a profitable trader. I had a bad month last month. So what was the outcome? I made just 1% profit. I made just 3% profit. Meanwhile, on average, I make anywhere from 5% profit and above. But this month I did 1% profit. Oh, this month I was at break even. I didn't lose, I didn't gain. Oh, this month I'm down negative 1 or 2%. Can you see the difference? Both went through a bad month. The trader that is here to find consistency blew the account. The profitable trader is just down negative 1% or at break even or just positive 1%. You understand? That's the difference. So I always wonder why people blow their account. But I understand. I mean, you have $100 account, your monthly bill, if you are in a very, very let me say normal country, right? Where maybe $200, $300 will solve your problem for the month, right? And you have $100 invested in the market. Of course, you want to make $200 to cover your bills for the month. All right. And that's why many people blow their accounts, right? So Daniel Seku was the same. Small account, big expectation, one emotional trade, blown account, regret, reset, repeat. The turning point, Daniel discovered prop firms because it didn't come from much, right? So no inheritance somewhere that he can take enough risk. I've spoken with a lot of people through the course of since when I went public with my mentorships, right? I've met people from different parts of the world, online, of course, and some of them whenever I travel. But the one, basically, most of the conversations I've had, I've seen beginner traders tell me that, hey, 3 months ago they blew $40,000. I was like, what? When I was starting out, I didn't even have $100 to my name, right? But well, probably that was a good thing, probably because I may have had the same experience that these individuals are trying to communicate to me right now, that oh, they blew 40K last month, they did this, they did that. And I wonder, I mean, you don't have a profitable strategy yet. Why would you allow yourself go through that severe loss like that? Well, we are humans who do whatever we want to do anyway. So Daniel discovered prop firms. He got a 10K prop firm account, but he treated it like his old $200 account. He rushed trades, over leveraged, and failed to challenges. Now, this is the norm today. And that is why traders that are yet to find consistency in their trading keep feeding the lifestyle of these prop firm owners. It's a market where 95% of retail traders fail, and their clients or customer base are retail traders. So what do you expect? They're living large. Why? Because you buy a 10K prop firm account. See, personally, I get a lot of DMs on a daily basis. I can't even keep up sometimes these days. You see someone asking you, what should I risk? What should be my lot size on X account size? And I wonder, no, that is a wrong question. The right question is, what percentage of my account size should I be risking, not what lot size? Sometimes I just, whenever I'm bored and probably I have some free time on my hands, I jump on YouTube. Then if I see some trading videos, I'll just click. Then when I click, I quickly just go to the comment section and I read through, and I see people asking questions like maybe the video is on risk management or stuff like that. Then you see people in the comment section saying, you were not risking a consistent amount of lot size. That was why you didn't get the result. And I'll be like, why are you putting your foolishness in public? You obviously You are obviously not a good trader when you ask that question. You are obviously not a good trader when you say you should be using the same lot size per trade. No, the question should be, the only time you can use the same lot size per trade is when you are trading one specific asset, the amount of stop loss in pips. Then that's the only time you can use the same lot size. You understand? But if you're someone that is trading multiple assets, someone that your stop loss pips is inconsistent, today it may be 20 pips, tomorrow it may be 30 pips, the next day it may be 10 pips, you cannot use the same lot size at that level. So your focus should not be what lot size should I use on this account. Your question should be, what percentage of my total account, of my total capital, should I be risking per trade? That is the right question. Then that way we can now respond by telling you, hey, get a risk management calculator. Before any trade you jump into, put in your stop loss in pips, choose the risk, the asset you're trading, then put in your account balance and hit calculate. Then it's going to suggest what lot size to use. The lot size reflects your risk on that trade. That is why after placing the trade, after calculating your position size, if you're trading on a desktop or on a computer, if you move your mouse and hover above your stop loss value, if you keep your risk consistent, you'll be able to discover that regardless of the lot size that you are using today or yesterday or tomorrow, your stop loss value in terms of cash, your stop loss cash will remain the same. May not be exactly the same, probably $5 above today or $5 below tomorrow, but around that figure you're willing to risk per trade. All right. That's how you can make it in the industry. And I'm going to show you with proof as we continue. All right. So this guy, Mr. Daniel here, was treating his 10K like the 200K. No risk management, nothing. Rushing trades, over leveraging by over risking, and failed 2 challenges in the process. Then something clicked. Now, this is the only people that can relate to this are those that are now making money in trading or have made money, even though for a brief period of time you actually withdrew a substantial amount of money. Now, the mindset shift, you realize that this isn't gambling money, right? This is not a gambling account. This is a business loan. Look at your Profim account as a business loan. It's not your money. You can't do however you like on it. Now, the only time you can be in charge is when you start making withdrawals from your Profim accounts. You are now building your own personal brokerage account. All right, that makes sense. For your Profim account, until you make a withdrawal, it's just a loan. Because if you mess things up, that's the money you paid to purchase that account size is gone, right? So he realized that this is not a gambling account. He saw it as a business loan, and that changed everything, right? So what mentorship changed? Daniel learned to trade properly. So mentorship now comes in 2 forms. You can pay or you can choose to learn on your own. You understand? You can either pay or you can learn on your own. Of course, one is faster than the other, but when we say mentorship, don't just take it as you're paying for mentorship. You can also learn on do your due diligence, either by paying for a mentorship or learning on your own. Do your due diligence, right? To become a doctor, you had to go to school. You had to learn the job. To become an engineer, you had to go through mentorship. To become anything, even to become probably a software engineer or whatever it is, you had to go through that learning process. Either you paid someone or you studied on your own. Then you had to go through mentorship, right? You have to learn to be a master at anything, right? So Daniel learned to trade properly, risk only 0.5 to 1% per trade. I personally risk 1% per trade on my funded accounts. Then Daniel also waited for high probability setups, right? Just build a strategy that is backtestable. You've backtested it. You've seen the worst case scenarios, but you always end up in profit over a long period, over a period of time. May be long, maybe short, but you always end up in profit through your backtesting. He also stopped trading every day, and he realized the importance of protecting your capital. I always say this, especially in the beginning of my channel. That was like 2 years ago or so. I always say, make sure you have your accounts intact to fight another day. All right. The markets has different cycles. Today it is very good. Next month it's ranging. The third month is doing something else. You cannot have consistent results across board. All right. But the main thing, one thing you have control over, you can't control the market, but you can control your capital. I think I've said this over and over across different webinars, right? Where I said, when you are in a drawdown, cut down your risk. You can't keep risking the same thing. Now, this is the difference between profitable traders and those traders that are yet to find consistent profitability in their trading. The difference is the profitable trader doubles down, increases his risk as he's in profit. But the trader that is yet to, the beginner trader, they double their risk when they are in a drawdown. That's the wrong way to approach it. All right. So capital preservation should be the top of your list before you consider making money. Look at it this way. You are a business person outside of trading. You are a businessman or woman. And you are trying to invest in a particular business idea. You can't just jump in blindly. You first of all do your due diligence. You want to see if this is going to be a profitable venture or not before you decide to jump in. And even when you jump in, the first thing you're trying to protect is your capital. You don't want to go below your capital. The first thing you're trying to protect is your capital before you now look at profit. I don't know if you do that, but I do. Any business idea I go into, I have some businesses on the side that I run thanks to Forex that has been able to fund these businesses. But what I look at is not how profitable that business idea is. I always ask, the first question I ask myself or whoever is pitching me that business idea is, what's the worst case scenario? I don't ask how much money can I make first. What's the worst case scenario? What's the downside? How bad can it be? Right? I think when you're writing your business proposal, that's where you hear something like, what's your SWOT analysis? Correct me if I'm wrong. I think, yeah, that's where you put in your SWOT. So how bad can it be? What's the downside? All right, this downside will not sweep me out of my capital. So now let's look at the upside. You understand? That is capital preservation first, right? So let's go to the next slide. So the results, consistency, excitement. So you made this first payout and then second payout. Let's ignore the figure. But once you make that first payout, boom, your confidence goes off the roof, right? So for the first time, trading paid for rent. My goodness, I can remember mine. Oh my goodness, I can remember mine. And that is the moment you realize that it was all worth it. That was the moment you realize that it was all worth it. The moment, yes, you are doing okay, you're doing other jobs, right? But we are all here because of trading right now. We are in this class because of trading. Trading paid your rent, not because you can't pay your rent. You're paying your rent, you're doing okay, but you want something from this market. Imagine trading, paying your rent, buying you that your house, buying you your car, putting food on the table. You will never remain the same. At that point, everything, all the stress is worth it. At that point. So that is why I always encourage traders, don't put all your problems on that one innocent account. Give yourself time. Pass the account. So I'll still talk about this towards the end of the session. Pass the account. Just make a withdrawal. Make a withdrawal. Something substantial enough that you can use to buy another account. So while you're battling with that new account, you're taking something from this. Give yourself time to grow. The market is not going anywhere. Sometimes we approach the market like it's going to close tomorrow. So let me quickly get what I can get before there will be no Forex market again. All right. So the market at this point, from your struggles to now being profitable, to now making your first withdrawal or your second withdrawal or your third withdrawal, what changed? The market has remained the same. You are the one that changed. You now have better understanding of how the market works. You now have better discipline. You are now a super trader. Then it's all the way up from there. You now want to see what you're still struggling with, what can you fix, and all of that. All right. Now let's go look at some data. When I was preparing this slide, something came to my mind. I said, hey, to further buttress my points, let me go to ChatGPT and ask, who is the best hedge fund manager in the world? You can go ask this thing yourself. Just take this prompt. Who is the best hedge fund manager in the world? So according to ChatGPT, there is no official best. Okay. So let me continue. So okay, I'll talk about this later. So there is no official best hedge fund manager in the world. It depends on how you define best, based on returns, consistency, risk control, longevity, innovation, or assets managed. Now, that said, in professional finance circles, one name comes up more than any other. I think I mentioned this name during one of my November analysis or October. I can't remember. Sometimes last year, though. The most widely regarded answer is Jim Simmons. Now, we are not here for his name. I just want to take it I want to take it somewhere. Look here. This is the name of the company, Renaissance Technologies. You can go look it up yourself. It's public information. Now, I just want to show you something here. This is where the webinar starts getting interesting, because I want to open your mind so that you will now know what your problem is. Because when I got to this point earlier in my trading career, that was when I realized that, okay, I don't have enough money to make this percentage that is being recommended to me worth it. So what do I need? I need more money. And thankfully, we are talking about prop firms today. Now, look at this. The best hedge fund, or this Jim Simmons, that is considered the best hedge fund manager in the world, makes average annual return of 66% for over 30 years. Let that sink in for a moment. For over 30 years, he averaged 66 daily returns, 6%. Now compare the best man in the world to you, that corner of your own, trying to better the smartest traders in the world. It's not impossible, but I mean, just be honest with yourself for a moment. Or now come down here. Professionals, that Simmons, sorry, I'll take that again. Jim Simmons, greatest investor of all time, just among hedge managers, goes outside his what do they call it, circle, right? Now, even Warren Buffett reportedly called Simmons' results extraordinary. Now, by 66% by 12 months, that means he averaged 5.5% per month. Just last month, I even did better than that on my normal brokerage account. I posted it on Telegram. I think I even have this screenshot here somewhere on this slide. We'll get there soon. So I want that to sink for a moment. Then who are you compared to? These people that consider Jim Simmons the best trader in the world. I know the next question in your mind will be, okay, I don't have enough money to make 5.5% worth it. But you're forgetting that you have prop firms. You are just impatient to go through the first and second phase. Because once you get to the funded stage, you start reaping the rewards of your labor. So you don't have 2 months. You don't have 1 month. You don't have 2. Okay, let me take it again. You don't have 1 month. You want to pass your challenges in 1 week. Why that is possible, it's not like it is impossible. It's doable. But do you think you can make it happen? Are you also okay that? Are you also fine with the fact that, hey, I may not be able to make it in 1 week, but I don't care if it takes me 4 months. How bad can it be? 4 months, worst case scenario. That's a long time. Yes, we both agree on that. But when you start making the money, it's going to be worth it. So why are you comfortable blowing accounts? You are uncomfortable waiting for 4 months to pass phase 1 and 2. That's a long time. Like I said, I know. We've all agreed on that. That is a long time. But it's not uncomfortable for you to blow accounts over and over again for 1 year. You understand? So look at this trader that is considered the best in the world and look at his average returns over 30 years. Then compare this kind of person to yourself that is trying to flip accounts. Right? Let's go to the next slide. These are other contenders. I won't go through them, right? George Soros, we all remember George Soros. His own was one big trade. That's why he's here. And let's go to the next slide. I think there's something. So simple takeaway. Best pure performance ever. Jim Simmons. You understand? Overall performance. And this is someone that did 66% per year. Divide that by 12, will give you around 5.5% per month. So how does this work? Now look at this. I posted something. I think it's here. Guess how much I did last month, even though I stopped trading early. On this slide, you will see this is the signal. Sorry, I changed the name to the January VIP group, but it was actually December 19th I posted this, right? So notice something. I did positive 3% on prop firms. Why? Because I was risking 1% per trade, right? Then I did 15% on my normal brokerage accounts. Why? Because I'm risking 5%. So if you understand your strategy, very well, you'll be able to know how to allocate risk to get the best returns that you're looking for. Right? Let me make sure that we are still together. Please, if you can hear me, just raise your hands again real quick. If you can hear me, I just want to be sure that we are together. Okay. Thank you. All right. Thank you. So let's go back to the slide. So we need to see what we are doing wrong, and we need to be see in any walks of life, right? I know some people will be like, what the hell am I talking about? It's fine, but you can only tell me that if you're actually making money yourself. If you're not making money, then the jokes is on you. That's just the fact. If you're not making money consistently, because yes, you can make money 2 months and the next time you make money is after 5 years. But if you're consistently taking money out of the market, then you can query me on this, because this is not me. I'm not Jim Simmons. The best trader, the best performance ever over the course of 30 years did 5.5% on average, monthly average. Then there you are trying to chase 100% returns, right? Let's move on. So let's look at, like I said, this is a very, very robust webinar. And I just want to paint a picture, open our eyes, then you be the judge of how you want to proceed 2026. All right. So let's look at some prop firm data. The best way to do this is to go to YouTube, but I can't come on the webinar and be playing YouTube videos, right? So I will tell you after tonight's class, thank God the weekend is upon us already. So take your time, go to YouTube, just type prop firm data, any prop firm, whether it's a big prop firm or small, there are videos there that you can actually watch. Go watch the performance, the behind the scenes data of the profitable trader against the ones that are not making money. within the online prop firm space. All right. So I can't play YouTube videos, but they are there. Go search that yourself. But I used ChatGPT again to scrub the internet. I gave it this prompt: scrub the internet for prop firm data on winning traders. I know all these things because I'm aware of all of these things that is happening in the market. I could just put it as a slide here, but I just want you to go check for yourself. This is public information right here, right now, right? So I say scrub the internet for prop firm data on winning traders on winning traders on their platforms. That's the prop firm platforms. That's losing traders that lose accounts. I don't know if this is the best way to prompt ChatGPT, but I think I did fairly good. So also point out data that differentiates profitable prop firm traders from losing prop firm traders, e.g., the average risk management that divide both sides, right? So this was the response, right? With links in front of them, right? And if you go to YouTube and try to look at these prop firm data, anyone you click, you'll see that it is around these same figures that ChatGPT has given to us. Like I said, I can't come here and be playing YouTube video. It's public information. Go to YouTube and search for yourself and see for yourself. I've always said this in other webinars. So I think now is the time. If you've not gone to check for yourself, go do that now. All right. Or after this session, of course. So overall success and failures. Failing traders, majority. Failing traders, they are the majority. I mean, 95% of traders, retail traders, don't make money. They are the majority. So 80 to 96% of traders never receive a payout from prop firm challenges. 80 to 96. When it comes to failure rates, you always want to go for the high end. Just ignore the 80. Let's focus on 96. Right? So 60% of all prop clients ultimately lose capital. They invested in challenges. 80 to 94% fail the initial evaluation at least once. Okay, let's ignore that. I also failed about 2 or 3 back then before I became profitable. And then it was not I was trading with my normal brokerage account. I was applying the same risk on the prop firm account, right? I think I've said this in many videos. So it took me about 2. I lost my first 2 prop firm accounts with MFF before I became funded, right? And after my first withdrawal, boom, those that have been with me since 2023, they know this information, right? So many traders burn through multiple challenge fees. Let's ignore that too. Let's come to winning traders. So only 5 to 10% pass evaluation phases. Now look at this. Even within the profitable traders, now look at this. Only 5 to 10% pass evaluation phases. So out of 100, only 5 to 10% pass evaluation. Let's give this number a higher number now. Let's say 10% pass. Then among the 10%, only about 7% of the 10% achieve a payout. See how crazy that is. 100 people applied for a trading challenge. Only 10 pass the evaluation. Now, out of the 10, I think less than 1, because it's 7% of the 10% that passed that made it to a payout. So less than 1 trader made it to the payout. It's crazy, right? So about 40 to 41% of those who trade successfully eventually show profitable performance. All right. So let's just ignore that. So surveys suggest 15% of funded traders stay consistent enough to withdraw payouts regularly. Feel good about myself right now. So long-term consistent success, e.g., 1 year of profitability, is often under 15% of those initially funded. You see, it's crazy. Even those that are already funded, that has already made withdrawal, they can't even hold an account for up to 3 months. So in simple terms, for every 1,000 who attempt a challenge, roughly 70 to 100 pass the evaluation, but only perhaps 10 to 20 get funded. Now, out of 1,000 applicants, only 10 to 20 get funded. They're not even talking about the withdrawals, just to get funded. Out of 1,000, only 10 to 20 gets funded. I'm speaking to you now somewhere, that maybe just that one person that thinks you can just do how you like in trading because you've watched YouTube videos. They've ministered the flipping mindset is embedded into your trading, and you think you can just make magic, can just flip, like clap your hands and you're making money. When they say trading is tough, it is tough. But sometimes we make it even tougher because of our poor mindset and approach. You understand? Okay, let's take for instance those that have been in my let me digress a little, because I'm not going to come here and lie that trading is that easy, but you can make money. I make consistent profitability. I make consistent profit from the market. On the signals, right? On the signals, this last week was very, very slow. Very, very slow. I only placed one trade, and that trade hit stop loss. I'm talking about within the signal group, because there was another trade I took, GBP USD trade, on the brokerage accounts that did fantastically well. But on the signal, we only trade Euro USD. The only Euro USD trade we took last week hit stop loss. Only one trade. Now, why didn't I panic? Why am I not under pressure to say, hey, let me place another trade? I know that next week I'm coming and I'll place 5 trades. I could place, okay, only 3 trades, and they may all be winners. You don't know the outcome of a trade on a trade by trade basis. So why didn't I panic? I had to wait from Monday till Thursday to call the first trade in the signal, Euro USD, which eventually hit stop loss, which is our first trade, and it hit stop loss. I should have just called another trade. The market was moving. It's not like it wasn't moving. It was moving. But XYZ has not come together, because those on the mentorship know my strategy. XYZ. 3 steps. This has to align, this has to align, this has to align. So if the market, like, let it move anywhere it wants to move to, XYZ has to align before I trade. That's how I measure my trading performance overall. I measure my trading performance within the system, not through randomness. I'm trading here, taking one trade here, doing this here, entering with this different model. No. Sometimes your entry is going to give you lower numbers of trade. Sometimes it's going to give you way more. It's all about making profit at the end of the month. You understand? And I can guarantee that at the end of this month, I'll still be profitable, even though I've lost the first trade in the signal. You see that confidence right there is because I've been doing it over and over again. October, we're profitable. November, we're profitable. December, we're profitable. I know some of the people on the signals are here. Tell me if I'm wrong, except you missed out on some of the trades, probably because of your schedule. But you can see when we called it. You can see when it played out. You can see when we hit CP. And that was why even towards the end of December, even though I ended trading around, I think I stopped trading around 18th or so, we still ended the month in profit. So what does this tell you? When you don't panic, you stay consistent to your system. That's the only way you can, and it takes discipline to do that. That's the only way you can be profitable. I don't want to believe everyone on this call right now don't have a profitable strategy. Some of us here, some of you here have a profitable strategy, but you lack the discipline to stick to it and let your winning trades run out. All right, let's just continue to the next slide. Now, key differentiators, profitable versus losing traders. Number 1, risk management discipline. That was what I wanted to say before coming to this new slide. I didn't want to just explain this since it's on the slide here. Consistent risk management is the single most cited difference between winners and losers. The single most cited difference. Now, 40% of traders fail prop programs due to poor risk management, not bad strategy. Okay. Successful traders focus on strict stops and position sizing. Those on the mentorship can attest to this. I don't go into any trade without a stop loss. TP can come later or whatever. The stop loss is the most, because you need stop loss to determine your risk. Right? So successful traders focus on strict stops and position sizing, rarely risking more than 0.5 to 1% of capital per trade. Now, this is within the prop firm space, because on my brokerage account, I always recommend, if you have a solid strategy, risk anywhere from 3 to 5%, depending on your strategy. Don't just risk blindly because I say so. You need to make sure that it aligns with your strategy, because if your strategy is a strategy that can give you 5 losing streaks, then risking bigger may be dangerous for you. You understand? So you need to understand how often you lose, the mixture of losers and winners within your system, to be able to allocate risk properly. You understand? So don't just take my word for it, except you can only do that if you're trading my strategy. You get? So, but stop and position sizing. What's position sizing? I mentioned this earlier. Not just guessing lot size. You are just saying, let me use 10 standard lots here. Okay, you know what? I'll use standard lots on any trade I go into. But you forget that your stop loss value changes. Today your stop loss is 20 pips. Tomorrow is 25. Next tomorrow is 10. You won't get consistent result like that. So position sizing is very, very important. I have a video on the channel. Just go on the channel and search for that video, how to calculate lot size. You understand? There's a tool, free tool, that you can install on your trading platform that will help you calculate your lot size fast. All you need is to put in your stop loss, then it's going to tell you the lot size to use automatically. All right. So, and you can only do this by already knowing beforehand the risk you want to take on every trade. So let's say you're someone that wants to be risking 1% per trade. You also need to feed that calculator that information. 1% per trade, 2% per trade. I want to risk 3% per trade. So it depends on you. So another factor again is high risk traders often violate daily loss limits or maximum drawdown. A common reason for immediate account termination. All right. So the impact, most losing traders blow their account not because their setup lacks edge, but because they exceed risk limits or trade too large relative to drawdown rules, right? If you risk too much, that's what you get. Now, another thing, strategy metrics, quality over quantity, quality over quantity. I see people placing 60 trades, 50 trades in a month, and probably I only place 10 trades the whole month. I still make more money than them, way more money than them. So it's all about quality, not quantity. You understand? Placing 60 trades, you can lose 35 and win maybe 15. You still won't be profitable. You understand? But even if you place only 10, 2 to 1, and maybe you win 5 and lose 5, you still make 5% profit. You see how crazy that is? That's if you're risking 1%. You understand? So traders with moderate win rates, e.g., 40 to 60%, can be profitable if they maintain risk to reward ratios of at least 1:2. Right? So profit factor and trade quality. Profitable traders typically have a profit factor of at least 1:5 or 1.5, meaning the total gains outweighs losses significantly. It's a numbers game. It's a numbers game. Winners usually hold winners longer and cut losers winner. They are not the type of traders that you are risking $500 on a trade, but once your trade is moving in profit of $200, you want to close. But if it's going to your stop loss of $500, you let it go. How do you mathematically make profit with that calculation? All right. So let's go to the next slide. So discipline psychology, consistency. So this is perhaps the most consistent theme across data sources. Successful traders follow a strict trading plan with disciplined entry or exit. You have to be disciplined once you have a strategy, not just a strategy, a rules-based strategy, rules guiding your every decision in the market, whether through losses, whether through winners. You are repeating the same thing, right? So number two, successful traders avoid impulsive trades under stress. You know, when you lose, it can be stressful. Now you want to revenge trade. You are now going on tilts, all of those stuffs, especially during challenge evaluation periods. Now, successful traders also tend to trade with consistency and, most importantly, patience, not overtrade or chase returns, right? Now, unsuccessful traders tend to overtrade or gamble. It's as simple as that. During challenge phases, they often fail to adapt to strict rules or management expectations. All right, so this is just like a breakdown, risk per trade, blah blah blah. I think let's just keep this. So why most traders lose accounts? Number one, they exceed drawdowns, whether daily or maximum drawdown. Poor risk size relative to rules, right? They are not properly sizing their trade. Then they are over trading and chasing profits under emotion. The market doesn't care about your emotion. Then you ignore, this is the part I want to emphasize on, you ignore risk to reward balance, even with high win rates. You ignore risk to reward balance. So the market doesn't care if your strategy is, it gives, there's one thing about this risk to reward that many people fail to understand, right? Especially when this mentors online wants to fool you. They'll just show you a data, 80% win rate. Do you realize that if you place a trade with $1,000 stop loss and you are closing $100 profit, your stop loss value is 1,000. You are risking $1,000, but you are closing $100 profit. If you close that 8 times out of 10, that's 80% win rate. The market will just count how many times did you win. Is it a positive outcome? Yes. It will count it as your win rate. You understand? So then don't let win rate fool you. Someone that has a 40% win rate is maybe making, or is most likely making more money than someone with a 90% win rate. So win rate is nothing. It's all about risk to reward balance. You understand? You are taking $100 out of $1,000 risk. If you do that for 8 trades, let's say you win all the 8, you took $100. Remember, you are risking $1,000 per trade, but once you're in profit of $100, you are closing. Now your profit is $800 with an 80% win rate. Meanwhile, somebody that is risking $1,000, someone that is risking $1,000, lose 5 trades, no, lose 6 trades and win only 4. Lose 6 trades and win only 4. Lose 6 and win only 4 has made $2,000. You only made $800. Yes, with your high win rate, you have a high win rate, but you are closing trades too early. The trader with a good risk to reward balance that lost 6 trades out of 10, that is going for 2-1, lost 6, win only 4, will be up $2,000. You with your 80% win rate, you are just up $800 because you're closing at $100, even though you're risking $1,000. So do the maths, right? So I think let's just go off this slide. So pass rates, this is just a breakdown. Pass rate, pass/success rate. Those that pass evaluation is just 10%. Then only 7% of the 10% make it to payouts. The losing traders, 95% of them never reach funded stage. Profit consistency. The winning traders sustain profits over time. Then losing traders, their initial profits, you make profits, you blow it again, you lose. Risk management, winning traders follow a strict and disciplined trading plan, while losing traders poor and inconsistent mindset, right? Strategy edge, balanced and including risk to reward. But losing traders focus on win rates, because losing traders are the one that will cut winners short and let losers run, right? So psychology, a winning trader is always calm and consistent. Remember, not just through winning trades, but through losing trades too. While losing traders, they go on the spiral, like they just lose it, right? So, anyways, let's go to the next slide. So, why a $10,000 account is powerful? Now, I've said this a couple of times before, but let's talk about my focus here is just to talk about the mathematical way you can scale, right? Because, like I said, when I talk about this 10K account, remember, differs. Some people, the lowest they can afford could be maybe 100K account. They can say, oh, I can afford 100K account, which goes for around $400, $500, right? A 10K account goes for anywhere between $30 and $100, depending on the prop firm. You understand? So now, how do you scale? For those with the 10K account, you're wondering, how do I scale? 10K is too small. If I'm doing 5% per month on average, for instance, like Jim Simmons. So what do I do? 5% is too small. No, it's not. Give yourself time. I've always said this. I'll say it again for emphasis sake. Give yourself time to pass. If your strategy gives you 5% on average per month, take it. You can try to develop on a demo account. See how you can increase your win ratio and all of that. There's absolutely nothing bad with that. When on your life account, or let's say your prop firm account, even during the challenge phase, if you average 5% per month, take it. That means it's going to take you anywhere around 2 months to 2.5 months to pass phase one. Where are you rushing to? Remember, you are building an empire here. You're building a business. When you start withdrawing, all of those months you won't even remember anymore, right? So let's say you take on average you're doing 5% per month. So it took you 2 months to pass phase one. Then took you like 1 month to pass phase two. Overall, 3 months. That's a long time. Yes, I know. 3 months. Now you are funded. You're still averaging 5% per month. Remember, five average is not like, hey, every month 5%. There are some months you may not make money, you're at break even. Then the next month you could do 7%. That's why I said on average 5%. Now on the fourth month, you now make your 5% profit. They refund the money with which you purchased that 10K account in the first place, and then they pay you your 80% profit from that 5% that you made. It can be higher, but industry standard is 80%. They'll pay you 80% of that $5,000, and you can invest in a new account, right? That was how I built my firm account. Even though I had enough money at the time when I embraced prop firms, I still started with a 10K account just to get used to their system. So after the first payout, I reinvested everything in a bigger account. So you want to scale so that you're still making the same 5%, but because you've scaled up, that 5% is now a very, very huge number. At this particular point in my trading, only 1% on my prop firm alone, 1% is enough to cover all my bills for the month, no matter how I choose to live my life. You understand? So trade to that point whereby that small percentage is a lot. And thank God we have prop firms today that you can leverage on, right? So trade like a professional. Prop firm rules teaches you capital preservation and risk management. First of all, protect your capital. Don't be reckless with your account. Protect your capital. Your strategy should be a strategy that should protect your capital, and always apply risk management. Don't be risking 1,000 and you're taking profits of 500. All right. Sorry, I'm trying to move fast as I can because our time is fast spent. But We're rounding up already, right? So you don't want to be that kind of trader. It's going to be difficult for you to take profits that is lesser than what you are risking in the first place every trade. It will be difficult for you to turn your losing trades into profits over time. All right. So consistency over excitement. You win one trade, you're all over the place. You lose one trade, you are losing your mind. Right? It's all about consistency over excitement. Keep that itchy fingers to yourself. You understand? I can imagine. I used to be there, right? Every time I'm on my computer trying to place a trade, it's over the years I've been able to build my strategy to a point where I know exactly when I'm coming to the market. I'm not always on the chart. I know when to come to the market. I know exactly what I'm looking for. If I don't see it, I'll be able to tell if within the next 4 hours I'll be placing a trade. And that's why those on the signal can tell. I'll always give heads up that we may be placing a trade so time. That's how I've structured my strategy. I can tell if there's a likelihood I'm going to be placing trades within this period of time. And if I'm not, I know I can go do other things. I know when to come back to the chart. So build a strategy that can provide you consistency, that is back testable, that you can see through historic data to tell if it's a profitable strategy or not. You understand? Then just executing the live market, no excitement, nothing. The only time you should be excited is when you even make a withdrawal. Why are you happy? You understand? So also think long term. That's the problem of struggling traders. They always just they want it now. You need to think long term. Look at all the big business people around you outside of trading. Big business men or women around you, wherever you're coming from, just look around. You see the time they put in, the time they give themselves to grow. Where they at, they were not there 5 years ago, they were not there 10 years ago. The investments they have today, they built it over time. You understand? So think long term if you also want to make it in trading. All right. So also be that trader that stops asking, how much can I make today? I see people sometimes, some of the people that wants to sign up for mentorship, sometimes they ask this question. They'll be like, with your strategy, how much can I make every day? Are you kidding me? In your day-to-day business, do you have a specific amount that you make every day? So you think the market is different because there's candlesticks printing every minute. So you think you can just know exactly what's going to be happening in the market every day. So you can be able to actually, it's not just you, actually. I remember vividly. I think if I go through my library now, I will still see those my jotters from way back. Where I remember back then I said if I can just make $5 per day. $5 per day. Well, back then I'll say if I can just make $5 per day, I will enjoy my life, back then. Crazy. But anyways, let's continue. So, but then I remembered, I put down, if I can just make $5 per day, I'm good. I'm good. I'll be able to pay my little bills here and there, right? Thinking about it today now is funny, but let's skip that, right? We all come to we all operated at that level in our trading journey, right? But over time, through experience, you will come to that point where you realize that it's not possible to make consistent income per day because some days will be a loss, some days will be a winner. Imagine you're into buying and selling. You have a supermarket, for instance, that you go to every day. How do you want to go to the customers or the client's house, put a rope around their neck and drag them to your supermarket to make a purchase from you so that you can meet up with your daily goals? Now, that's not possible. So why do you think it's possible in the market? Right? That's a rhetorical question. So you want to start asking yourself, how do I survive and scale? How do I survive and scale? Capital preservation. How do I survive and scale? You want to survive, then make profit, then buy bigger accounts and keep growing from there, right? So small percentages, real money, right? This math changes everything. 5%. I think I've broken this down earlier. 5% on a 10K account is $500. The prop firms are going to take industry standard 20%. You'll be left with 80%. You can reinvest. A 10K account costs anywhere, like I said earlier, between $30 and $100. FTMO, I think over $100, right? But then 25K account is around $150 to $200, depending on the prop firm you're trading with. And then we have the 50K account. From this 5% return, you can scale. Give yourself time. I don't want to go into details because this particular explanation I'm making right here is something, if you've been attending my webinars, I've done this enough. All right. Stop trying to discard that flipping mindset in 2026, please. If not, I'll take me to anywhere. Send me a DM after now, right? I will put down $10,000. I'll put down $10,000. You just put $500, but I will eat your money and I will not give you back. I guarantee you, trying to flip, not like if you do it one time, you tell me, oh, I flipped one time. No, flip for the whole year on one account. Then at the end of the year, I want to see your P&L. I want to see everything. Because if you do it one time, everyone can do it one time. I flipped account. In fact, I do it with news, but let's keep news. Even when I was starting out, you know that beginner's luck. I flipped account multiple times. So it's not like it is impossible. Anyone can flip accounts. If you flip a coin and click buy or sell, you can easily flip an account. But I'm talking about consistency in trading. When you actually know what you are doing, that's the difference. That's where consistency comes. It's not about I flipped accounts one time, so why are you telling me it's not possible? Can you do it consistently like that? Keep flipping accounts consistently for 10 years. I'm not talking about that one time or that 2 times or those 3 times. I've done it myself. But why didn't I continue with that? By now, probably I'll be in my village. You understand? So let's go to the next slide. Confidence comes from proof. Confidence comes from proof. Payout changes everything. Please get to that payout. I said this in the beginning of this slide too. Confidence comes from proof, right? Payouts change everything. So once you get paid, you stop doubting yourself. You stop hopping strategies. You stop chasing signals because you're now a boss of your own, right? So trading becomes a business at that point. That confidence, that withdrawal makes you feel good. To be honest, if possible, your first withdrawal, print it out, frame it, and hang it somewhere so that you can always remember what you did to make that withdrawal so that if you've gone on tilt now, you know what to fix. So the harsh truth, most traders want results. They want funded accounts, but they hate the rule. I want funded accounts, but I don't like the rules of the funded accounts. They want payouts, but they avoid structure. Without structure, you can't make payouts. Even if you make payouts one time, you can't consistently make payouts. I'd rather be a trader that makes consistent payouts. I'd rather be a trader that makes consistent payouts than just one payout, right? So most traders also want freedom, but they hate discipline. It's like you didn't put in the work today, or you want to make the money tomorrow. You understand? No, you didn't put in the work today, but you want to reap the rewards tomorrow. It's crazy, right? So prop firms reward structure, not hype. Prop firms reward structure, not hype. If you don't have the structure, if you don't have proper structure in place, you're all going to come crumbling down. All right. So the reality check, a $10,000 account alone won't save you unless you become the trader that deserves it. Do you really deserve that payout you are looking for with the way you trade, with the strategy you trade, with your mindset, most importantly? Do you think you deserve consistent payout in the market? It's not by not sleeping, you're always on the charts, putting in the work. It's not limited to that. You need to have the proper mindset to go with the strategy and the discipline to let your rule play out. Okay. So why mentorship matters? Mentorship gives you a repeatable trading model, whether you pay someone to learn or you learn on your own. It gives you a repeatable trading model, prop firm friendly risk rules, how to pass challenges, how to protect payouts and scale your accounts. Very important. All right. So now our mentorship is coming up on Monday. Our next mentorship is coming up. Our 2026 mentorship, first mentorship of the year, is coming up by Monday. All right. So if 2026 must be different, you must trade differently. The first thing you need to do, whether you can do it on your own or you pay an account. If you're doing it on your own and you are yet to find consistency, then you still need to dig deep. As a matter of fact, if I were to go back in time and start my trading all over again, many of my friends that I don't talk to, though we are now back in talking terms because I've been able to give them back their money, even though I told them that, okay, someone is messaging me, please don't worry, I will respond to you after the class, please. I'll respond to you after the class, please. Please, please. Your messages are distracting me, so but don't worry, I will attend to your issue after the class. All right. So where was I? Where was I? Man, just keep my mind. But anyways, if 2026 must be different, you must trade differently. All right. So join the mentorship, which is coming up on the 26th, sorry, on the 12th of January. Learn the structured business of trading. So become the trader prop firms pay. It's not just being the trader because you are burning the midnight candle and you are still not there yet. All right. So stop gambling and start building. All right. So thanks for all the attention. I believe that you've put down your questions somewhere. I think now is the time to take your questions. So if you have any question, please raise your hand and you'll be allowed to speak. Once I allow you to speak, all you need to do is to click the unmute button. Then you can just tell us your name, where you're joining from, and then your question. Okay, I see Mrs. Rachel, you've been allowed to speak. Kindly go ahead and unmute yourself and ask your question. Please go ahead and ask your question. Okay. I think while we wait for Mrs. Rachel, let's go with Mr. Olu. You've been allowed to speak, sir.
Yes, sir. Good evening, sir. How you doing? You okay? Happy New Year.
Doing good. Same to you. Thank you.
Can you hear me, please?
Yes, I can hear you. Please go ahead.
Yeah, actually, I wanted to find out if you know anything about these.
Sorry,
Prof-
you didn't tell us your name and where
oh,
you're
sorry.
joining from, sir.
My name is Solubuni. I live in the UK, Southern North Sea. My question
Okay.
is, I don't know if you know anything about these ProFam, leverage, sure, or funded trade. They do this kind of funding where you buy like 100,000 account for $10, and once you pass the challenge, then you pay the actual fund, which is about $700, $600, something like that. I don't know if you've
Okay.
heard about them. Yeah. I did try that, and this was a couple of weeks ago, and I got two funded account of 100,000 each, but I don't
Okay.
know how legit they are. So I just want to find out if you know anything about them, please.
Okay. Personally, I like to go with reputable prop firms. You understand? And when I try out newer prop firms, which I rarely do, But when I try out newer prop firms, what I like to do is I try to test the waters first. Do you understand? Let me put it this way. First of all, you want to do your due diligence. You want to look at trust pilot. You want to kind of like see if they are who they say they are, right? Because prop firms spring up every now and then, right? But when it comes to payouts, the honest truth about prop firms is if they don't have a large customer base, you may have problems with payouts. Because, truth be told, most of these prop firms make their money from losing traders, loan accounts, right? So they pay the 5% or the 3% that are profitable within their platform. They pay them from those losing traders challenge fees. All right.
Yeah.
So when you are even profitable, personally, from my own experience with prop firms, even if you can do 30%, there are a handful of just a few prop firms I can do outrageous numbers on, like FTMO, like Funded Next Now, like which other big prop firm is out there, like E8. Those are prop firms I can even do 30K on, and I'll place my withdrawal, they'll give it to me. You understand? But there are some smaller profs where if you do some kind of numbers, even if you can do it, they won't want to pay you. Now, that said, back to your question, when I see prop firms like that, I feel like they are desperate because the first question I want to ask myself is, if I eventually pay that makeup money, are they going to pay me? Because there are many traders that may pass and may not be able to complete their payment. So where would they get the money to pay me? Because when they say they copy your trades, just forget about that. Yes, when you show consistent profitability in your trade, I've said this many times throughout some of the previous mentorships I've done before within this platform, that I am A-booked with some prop firms. You understand? I'm A-booked. If you don't know what A-book means, I'm B-book. A-book is when you are trading a live account. Then B-book is when, if you're trading with a broker now, not prop firm, you would think you're trading a live account, but you're actually trading one demo account. You are not connected to the liquidity at all. Maybe after today's class, go Google what A book, the difference between A book and B book among in trading means. All right. So, anyways, back to the question. So, if people cannot provide liquidity and this program is still new, it's not like they are actually copying our trades. Where would they get the money to pay me out? You understand? I would rather go with a prop firm where I pay everything up front. I know that other losing traders are paid their money, they will be able to have enough money to pay me.
Yeah.
You understand? But if have I looked at them, the answer is completely no. I've actually not looked at them. What did you call the name of the prop firm again?
One is called funding trade, and the other one is
Okay.
sure leverage. Yeah, I mean, I did check the Trust Pilots, and I read so many review. The review seems to be good, and that's why I went for them, and also because you just pay $10 for 100,000 pounds, but you only if you pass the account, that's when you pay the full price, the full amount, which is about, I think it's about $700. I mean, yes, 700. Yeah. So
For a
I don't
100K
know. That's
account.
for 100K account.
Okay.
Yeah, one of
Whew.
one of them is
Anyways,
600, one of them is 700. So I don't know which is which, but
do you
yeah,
know
but you
anyone personally that has made withdrawals from that account?
not
Someone you can,
really.
even
I
if you
mean,
met the
not
person online.
not really. I mean, I went through their website, I went through their reviews and everything. People say they're getting paid out, but I don't know how true that is. So, but
Okay. On okay, if from
excuse
my own
me.
personal experience with prop firms, from my own personal experience with prop firms, I actually would mm, really would be skeptical about that type of firm, to be honest. That's my own personal review. It doesn't mean anything, but
Yeah,
personally, I'll be skeptical with that type of firm. That's just my own opinion. the best thing to do in this kind of scenario is to try with a small account, see if they pay you out, then scale up systematically,
Yeah.
because at the end of the day, you only pay $10. When you pass, that's when you pay the
Yeah.
real money. So what do you have to lose?
Yeah. Also, sorry, I don't know if I have time to ask you more questions. I mean, other people
I
have
don't see any hands
questions.
raised. I don't
Yeah,
see any
okay.
hands raised. So yes, you can go
Okay.
ahead, please.
My second question is, what's the difference between a static and trailing stop loss?
Okay. Simply put, trailing stop loss is let's say you are allowed 5% drawdown, daily drawdown,
Yeah.
5% daily. That's what the prop firm is offering. And they're also on a trailing drawdown, right? So what that means is you bought the account. Let's use 10K for easy calculation. You bought the account, you bought a 10K account. Your daily drawdown limit at that point is a new account. So your daily drawdown limit at that point is 5%.
Yeah.
Now, if you trade and you make profits, let's say you make $100 profit on that account, the next day, your drawdown increases. Okay, let me start from the static. So if I take it from the static to trailing, you understand better. So on the static, your daily drawdown limit is 5%. So,
Yeah.
or let's say your maximum drawdown limit is 10%. So if you make profits, let's say you make $500 profits that day. So now you now have $10,500, right? You are
Yeah.
still allowed to come back to break even, which means you've created a 15% buffer for yourself because you just made, is it 15%? Because you just made an extra $500. I don't know if
You
my
make
calculation
extra
fine, but what I'm
500.
saying is this.
Yeah. You.
Yes, yeah. So you can still come back to drawdown. Meanwhile, trailing drawdown rule means you will not be able to come down to that 10%, that break even,
Yeah.
until the market resets the next day. So
Okay. Okay.
personally, I prefer static drawdown than
Trailing.
trailing drawdown. Yes.
Yeah. Okay. Yeah. Okay.
Prefer static
Thank you.
drawdown to trailing drawdown.
Okay.
Understand?
Yeah. Thank you so much
So
for
is
making.
that
Thank you.
all?
I really appreciate that. Yeah, that's it then. Yeah. Thank you very
All
much.
right.
I really appreciate that. Thank you.
You're welcome. So our time is fast spent. Um, I want to appreciate everyone for tuning into the session today. I appreciate you for staying to the end, and the recording is going to be available tomorrow. So if you have any other question after now, my DM is always open. I will respond as fast as I can, and I'll see you in the next webinar. Good night, everyone.